We have a quick question here from Cortez, who's asking us, is currency pairs like the Euro Aussie and the Pound Kiwi, as an example, considered as risk currency pairs? Now, Cortez, we will answer this question in two stages. Firstly, let's quickly see which currencies are considered risk sentiment currencies and why. So on this page, we can see that we have two sections here, two types. First one is a safe haven, and then we have a high beta currency. Now, we can see during risk off environments, we expect the safe haven currencies to strengthen, and during risk on environments, we expect safe havens to weaken. High beta currencies we expect to weaken during risk off and strengthen during risk on. Now, looking at the currencies more specifically, safe havens generally are considered the Swiss franc, the Japanese yen, and in some situations the US dollar, depending on the overall health of the global economy. And then looking at the high betas, that'll be considered like your high beta commodity linked currencies like the Australian dollar, the Kiwi dollar, as well as the Canadian dollar, also the emerging market currency. So during risk off tones, we expect the Swiss franc and the Japanese yen to strengthen, while we are expecting the Aussie, Kiwi, and CAD to weaken. And during risk on environments, we're expecting the Swiss franc and the Japanese yen to weaken, while we're expecting the high betas like the Aussie, the Kiwi, and the CAD to strengthen. Then coming back to the Euro Aussie and the Pound Aussie, we can also look at the Euro Kiwi and the Pound Aussie, for examples. The Euro and the Pound is not traditionally thought of as having too much reaction when it comes to risk tones. There has been exceptions, of course, but generally speaking, they tend to be more neutral when we have strong risk flows. Now, when we have a strong risk off tone, we obviously expect the Aussie and the Kiwi and the CAD, for example, to weaken. Now, that would give us theoretically an upside bias in pairs like the Euro Aussie and the Pound Kiwi. And when we have a strong risk on tone, we would expect the Aussie and the Kiwi and the CAD to strengthen, which means that we will have a downside bias, for example, on the Euro Aussie, the Pound Kiwi, and even the Euro CAD, Euro Kiwi, etc. But, and this is a big but, we only consider that a tradable opportunity if we have the opposite bias in the euro and the pound at that time. For example, in a risk on tone, we would expect the Aussie, the Kiwi, and the CAD to strengthen. So we would want a catalyst, a specific catalyst that is driving the euro or the pound lower, to consider that a higher probability or high conviction trading opportunity. Now, if there is nothing driving the euro and nothing driving the pound lower at that time, you would be better off just pairing a safe haven like the Swiss franc or the Japanese yen against that high beta currency with very strong risk on and risk off flows. That goes the same for something like the euro yen and the pound yen. For example, if we have a strong risk off tone, we expect strength in the Japanese yen and the Swiss franc. That'll mean that should give us a downside bias in something like the euro yen and the pound yen, but we'll only consider that a tradable opportunity if there is something specific driving the euro or the pound down at that time. Otherwise, we would just pair a strong expected safe haven against a strong expected high beta. So Cortez, I hope that answers your question. If there's any other questions, please don't hesitate to let us know.